Ernest Hemingway wrote, "How did you go bankrupt? 2 ways. Gradually, then suddenly." Keep that in mind as we watch a market rebound even among dire economic indicators. Throughout this volatility, what's clear is that markets do not really react to bad news, they react to uncertainty. If some invisible enemy threatens to kill millions of people, oh yeah, that is scary. Time for short call positions. But when the same thing actually does happen, oh well, it's already priced in. Time to sell puts by the dip. That's why markets can stay irrational longer than any logical person can stay solvent. Markets know that the government is going to print their way out of the problem. Markets know that governments won't let corporations fail, even if they should, because they provide jobs that people will need during economic recession. Markets know that progress is being made to isolate and contain the virus, while countermeasures, such as immunity tests and a vaccine, will arrive as fast as possible with the combined efforts of the globe. That small certainty is the same as saying,
if it bleeds, we can kill it.
Yes, these fiscal and monetary policies are artificially keeping the economy propped up, and yes, it is unsustainable long term. But the hope is that a barely functional economy stays together just long enough so that we can stop the pandemic and then address the economic crisis later. After all, nothing galvanizes support and gets people to put aside their differences like collective tragedy or a common enemy. Humanity will stand together and overcome this virus. But the virus is only the immediate threat. The real threat is on the horizon. How do you stand together and overcome a broken economy? Well, we begin, just as we've done with the virus, by first knowing our enemy, or at the very least, how we got here. In many ways, leaving the gold standard domestically in 34 and totally in 71 was the most important economic factor in America's history, and perhaps the history of finance itself. When President Nixon completely severed the US dollar from any link to gold in 1971, it became a completely free-floating currency. Debt became money. Put simply, cash ceased to be hard money or money that was backed by something. Therefore, it no longer maintained its purchasing power or value, so to speak. So I want to demonstrate to you how important this loss of value is and the real significance of what happened in 1971. That year, the birth of fiat currency, or money without backing, also gave birth to modern monetary theory, or MMT. Now, there's been a lot of talk recently about MMT, as we've seen unlimited QE and zero interest rates, but the truth is that MMT has been a reality since 1971. Here's why that is, and this might blow your mind. The US government does not use and does not need taxes to fund its operations. Taxes simply create demand for the sovereign currency, or the US dollar. The only true backing of modern fiat currency, especially the US dollar, is faith. Faith predicated on the notion that the US government continues to collect taxes. Again, the US government does not need to collect taxes to fund its operations. Instead, the reason the US government collects taxes, giving the dollar value, is because Americans need US dollars to pay taxes under penalty of law. Americans can't use gold or securities or bonds or even Bitcoin to pay taxes. Only US dollars. Without that requirement, no one would care for American money. Its valuation would evaporate. So that social coercion is central to maintaining a functional currency. And here's where it really gets crazy. This is the core basis of MMT, and why terms like budget deficit and surplus have no grounds in current reality, where the government can just print more debt to fill any hole. The government simply justifies massive fiscal deficits because it spreads the wealth outside the government to the private sector and to other countries. According to MMT, this is how things should be, and it's all possible because of a currency with no inherent backing. So currency, cash, has no backing, and so its value fluctuates, something that did not happen much when cash was backed by gold. Instead, cash became just another asset class like stocks or bonds, something that can rise or fall in value depending on how the financial system is functioning relative to various factors, inflation, economic growth, etc. However, there is one key difference between cash and every other asset class out there. When an investor buys stocks or bonds or real estate or commodities, he or she is helping to inflate the financial system. As we covered last week, the Fed loves this because it means your capital is helping to push these asset prices higher, which helps avert the dreaded debt deflation that the Fed wants to avoid at all costs. In contrast, when an investor buys cash by selling stocks or bonds or some other asset class, he or she is deflating asset prices and by extension, the financial system. And if too many investors sell assets and buy cash, hoarding it like dragons, it can cause a crash in the financial markets. As far as the Fed is concerned, there's reason enough to hate cash as an asset class. However, there's a second and even more dangerous component to cash, in particular, physical cash. You might find this hard to believe, but physical money, such as coins or bills, is in fact a systemic risk for the Fed. So to explain that, let's talk about money. Collectively, there's about 117 trillion in wealth in the US financial system. Of this, only 13.5 trillion is stored in cash, as opposed to shares in a stock, treasury security, or some other asset that would have to be sold to become cash. Of that 13.5 trillion stored in cash, only 1.5 trillion is in the form of physical coins and bills. Out of all the wealth in the US, just a little over 1% is actually physical money that you can hold in your hand. The rest is in the form of electrons stored on a bank server or brokerage account. And while you might find this surprising, this is intentional. To understand why, we have to go back to the creation of the Fed. Now, the original reason that the Federal Reserve banking system was created was to stop another 1907-style banking crisis. A crisis that was caused by unregulated banks making bad loans, which defaulted, which then caused a domino effect collapse of other banks, highlighted by the phrase "run on the bank," referring to how people scrambled to get their money out of the banks. So to stop a repeat of this mess, after the Federal Reserve banking system was established in 1913, every bank that was granted a federal charter to operate in the United States was required by law to join the Fed's banking system. The idea here was that every bank would be in some way connected to the Fed so that it would have access to a pool of capital if another systemic run-on-the-bank crisis hit. So because of this structure, if enough people decide that cash is king again and start parking their wealth in the form of cash, selling stocks and bonds to do so, well, it can cause a financial crash. And this is exactly what caused the 2008 crash, as well as the crash we saw a month ago. Where things really get turned up to 11 is if during a panic, people choose to move their money into actual physical cash. If enough people were to do so, the entire system would implode. Put another way, despite what Hollywood might make you think, the banks don't have trillions of physical dollars laying around in vaults to make redemptions if people start demanding their money in actual physical cash. The banking system would very quickly collapse without means to mitigate the supply and demand of that physical cash. So that's why the Fed will declare a war on cash in the coming months as the crisis deepens, particularly as the everything bubble continues to burst. Now, this war will feature three strategies. The first is negative interest rate policy, or NIRP. The second is cash bans on large bill denominations, such as $100. And the third is carry taxes on smaller physical bill denominations, such as $1, $5, $10, or $20. So let's discuss why this is. To understand, here's one of the ugliest charts you'll ever see. They don't show this chart in school for a very good reason. By depreciating the purchasing power of the US dollar virtually nonstop, the Fed has made cash a losing asset class, something painful to own. This is clear when you look at this chart because the buying power of the dollar is only 4% of what it was in 1913. Put simply, over the last 100 years, those who've stockpiled cash have had to choose between sitting on their cash and watching as Fed policy erodes the purchasing power of their money, or moving their cash into other potentially higher returning asset classes in an attempt to maintain their wealth. So in this sense, NIRP is just a hyper-aggressive version of this Fed policy in that it makes sitting on cash not only painful, but really painful. NIRP will be used as a reflationary tool in that it will first raise the pain threshold at which investors who own collapsing assets will finally panic and move into cash, and second, make sitting on cash so painful that those who are doing so already will eventually be forced to move into these risk asset classes, thereby helping to reflate the financial system. Put simply, NIRP moves cash from a neutral asset, albeit one that loses purchasing power in the long term, to a negative asset in the short term. As such, the Fed hopes to use it as a policy tool, with the goal being that as the bubble bursts, investors will be much more willing to maintain positions in various asset classes rather than panic and dump everything and move into cash. As such, negative interest rate policy will be one of the Fed's primary tools in its war on cash. However, NIRP only works if you cannot move your capital into physical cash. After all, a good home safe costs only a couple $100, so why would anyone with significant savings be willing to put up with NIRP of -3% or even -5% when they can simply move into physical cash and avoid the annual fees entirely? Well, that's why when the Fed moves to implement NIRP, they'll also be pushing for an actual ban on physical cash. Based on policies already being used elsewhere in the world, as well as proposals from financial regulators that have been itching to put this into practice, I believe this cash ban will take two forms. The first being an actual ban on physical cash, particularly in large bill denominations. The second being a carry tax on smaller bill denominations. Now, I can already hear your disbelief, and if this sounds completely insane to you, consider that it's a virtual repeat of what the US did with physical gold back in the 1930s. This is because the US already banned physical money once before when FDR banned the ownership of physical gold in 1933. The only reason we don't see that ban on gold as a ban on money is that today most Americans see the US dollar as money, while gold is thought to be more of an investment. So given what is at stake as the everything bubble bursts, I have little doubt that the Fed will be doing everything it can to stop capital from fleeing the financial system. The everything bubble is so massive in scope that even negative interest rates, nuclear levels of QE, and cash bans won't be enough to stop the inevitable debt deflation, particularly when it comes to banks that are overexposed to garbage debt. So later on this week, we'll talk about how alternative asset classes like gold and Bitcoin will help us mitigate some of these changes to the financial system, and how we stay solvent as the everything bubble bursts. All we can really do in the meantime is just to enjoy the ride. So I want to say thank you for watching this video, and I hope you enjoyed it. As always, your support of this channel really does make this possible, and know that I really appreciate it and your feedback. Hopefully this topic has stirred up a little bit of controversy and we can talk about it in the comments below. Or you could also get onto the free Ready Set Trade Discord and talk about how you're navigating the markets, especially in this time of uncertainty and volatility, with other traders and investors just like you. Additionally, we've just launched the new Ready Set Trade service. It's already an awesome community. So if you want to check out what we built and how to become a better trader, head over to readyset.trade, and don't forget to use the code LAUNCH at checkout to secure a 20% discount for life, which we're definitely ending soon, so definitely don't delay. As always, thank you so much for watching. Until the next one, cheers.